Hey everybody, it's me, Greg Manarino. This is my post-market wrap-up for today, Monday, November 13, 2017. First of all, Jenny Yellen's back. I know you guys and girls out there like my rendition of her, except I added a couple of horns to her. I think it's appropriate. Okay, let's talk. We have a lot to talk about. And if you seriously only watched one thing today, and that is the bond market, which you could see in real time, so you could be bewildered, literally, on my website, traderschoice.net. If you were watching the action in the bond market today, you were probably, again, going, what is going on here? Let's cover that just real quick. And let's back up. Let's just nudge back to Saturday. On Saturday, I wrote an article. I put a nice chart up there on Steemit. I said that if this bond market does not stabilize, there's going to be trouble ahead here this week. Well, what we saw, again, and you could see the tracings of it or the pattern. You do not need to be a chartist to see what I'm talking about. It's mind-blowing. We had a huge amount of buying of bonds early on today. So if you go to that chart on my website, you're going to see a big green line. That's all the buying. Buy. Then all of a sudden, throughout the day, it got sold off. Bang, bang, lower. But what this action did, whatever entity out there is doing this, okay, because, look, this is fake. You know that, and you can see it. It's unbelievable, okay? What they were successful in doing was, again, stabilizing the bond market. This is priority number one here. And the Fed is in a lot of trouble. I want to talk about that further with regard to the bond market and what they're going to have to do to make this all work, to try to make this all work. And we know for a fact they're going to get this wrong, but let's go over it again. So this huge amount of buying in the bond market led to a slow bleed off throughout the day. Have a look at that chart. You really should just take a split second. The stock market was under pressure at one point. The Dow Jones Industrial Average was down about 80 points at one point. Again, this is on the fear of what is going on here in the bond market, but they got it to stabilize. And what did that do? Well, stocks finished higher today. Not overwhelmingly higher, but they did not sell off. Why? Because of the bond market. It's incredible, and it's so simple, all right? I'm going to make a trader out of every single one of you out here, and I'm going to make you all rich. I'm going to make you all rich. It's the truth. All right. Here's the problem that Devil Lady here has, okay? And it actually got some coverage today on CNBC, to their credit. Okay, so you guys and girls on CNBC, I'm gonna praise you a little bit here. I know I'm hard on you, but bear with me here, everybody, including you on CNBC, who I know for a fact watch this blog. The issue with the bond market and the yield curve is profound. It's profound. I don't know another way to put it. And again, CNBC keeps talking about the flattening of that yield curve. Now, earlier today, I wrote another article on Steemit where I talked about the yield curve and how the stock market is being used as a prop and a distraction. This is why they would determine today, at least, to do something to stabilize that bond market. Now, here's where the trouble for the Fed is beginning, and it just started, honestly, It started at the end of last week when we had that big sell-off there. So with this flattening yield curve, the Fed is going to go, in my opinion right now, and tell me if this makes sense to you, to great lengths to prevent that yield curve from inverting. Why does the Fed not want to see a yield curve invert? Well, let's put it a different way. The banks, if the yield curve continues on its current trajectory and ends up inverting, banks, which run the Fed, are going to suffer. Well, why are they going to suffer, you might ask? Excellent question there. Well, banks depend, again, they loan out cash that that's printed out of thin air. and then they charge interest on that cash. Well, if the yield curve is inverting, they're going to be losing money by making loans out, let's say, on a home or a car, a longer-term investment kind of thing. They don't want this to happen. So what is the Fed going to do? Are you ready? Are you sitting down? Sit down. Okay. I can see you out there. I really can. Here we go. So the yield curve flattens out. The Fed is stuck because they're going to have to do something that they do not want to do. Do you know what that is? They're going to have to raise rates quickly to prevent the curve from inverting, to try to bring it back. Let me just say this. It's not going to work. It is not going to work. Mark this guy's words here. And again, if you've been following my work as of, I don't know, for the past months and months and months and months, I have been so accurate, I frankly scare myself. And I'm not kidding, but I work really, really, really hard at this. All right? So, December, a couple of weeks from now, I still stand by my call. The Fed is going to raise rates here. That's going to affect the short end of the curve, okay, the federal funds rate. Now, we know the Fed keeps talking about normalizing their abnormal balance sheet. By saying they're going to normalize it, it means it's abnormal. You understand? Okay. So, we already understand the little fits that this market takes when it sees the bond market act like it's doing right now. So could you only imagine what's going to happen when the Fed is forced to do something with the yield curve? In other words, they're going to have to raise rates several times next year to make that curve normalize because it's abnormal and it's going the other way. The market is going to have a fit over this, a freaking fit over this. So this is why the trouble here for the Fed here, you see these two things? Why their trouble has just begun. And I can tell you this, the Fed is going to screw this up big time. Again, they've created a financial monster. You know that. It's unlike anything that has ever been seen in the history of the financial world. And then again, now I'm going to talk bad about the people on CNBC, so I'm going to get some thumbs down here, and I'm going to probably get this video flagged. Back me up by giving me a thumbs up. People on CNBC, for the most part, again, are going to take the biggest flashlight they can find, a beacon, and shine it up your crack, because they do not want you to understand what's going on here with the yield curve, what the Fed is going to have to do to prevent the inversion of the yield curve, how that's going to affect the markets, how that's going to affect your 401k. You understand? This is what they do. They're trying to save their jobs out there. That's why they're over there. A guy like me, could you imagine a guy like me on CNBC? Hey, that rhymes. A guy like me on CNBC. Anyway, it would be kind of a funny thing if you ask me, because I'm telling you as straight as I possibly can. And I would imagine that what I am explaining and the way I lay it out for you makes sense. You know why? Because you, my friend, all of you, have several, in fact, a whole cluster of functioning brain cells. And I love that. And I love all of you. It's the truth. All right, so let's just put this all together today real quick as this wrap up. So a lot of crazy action in the bond market. Huge amount of buying. Then it bled off. You can see this on the chart. Have a look at it. Take a split second. There's a link in the description of this video. Right side of the page, underneath the chat room. It's incredible. Huge amount of buying, then sell off, sell off, sell off, sell off. But they were successful in stabilizing the bond market for now, for today. Well, we don't know what's going to happen tomorrow, but I can promise you, what I can promise you is they're going to try to keep the bond market where it is at this particular point. So the Fed, through whatever channels or back channels or sideways channels, upside down, whatever they got to do, that's what they're going to do. Keep that market stable, because the stock market, again, why? Is being used as a prop and a distraction. If the stock market's going up, the regular guy out there who doesn't even have half of a functioning brain cell thinks everything is okay, because they have no clue about what to do, where to look, or what's really going on in their life. They can't walk and chew gum at the same time. You know that. It's incredible. But anyway, so they were successful in stabilizing the bond market. Stocks did climb today. We'll see. what they're going to do tomorrow. It all depends on the bond market. So you got all these other nincompoops out there. Oh, let's look at the stock market. The Dow Jones Industrial Average is higher. I don't care, and neither should you. What you should care about is what's happening in the freaking bond market. All right, because that's what's going to tell you what's going to happen in the stock market. You know that. All right, look, I'm getting a little crazy over here, but it's just the truth here. All right, look, I'm going to let you all go. We're going to talk about more of this tomorrow. The first thing I'm going to be checking tomorrow is the bond market, because I don't care what the stock market's going to do, and then I'll accordingly move cash around, because that's what I always do. You know that, all of you out here. All right, with that said, I'll see you tomorrow. Bye.